China just dumped $300 billion in US debt, and if that sounds like a global finance problem, you might want to check your mortgage rate, because this isn't just some foreign policy chess match between Washington and Beijing. This is the kind of move that makes your 30-year fixed-rate loan jump 0.5%. Overnight. Yeah, Beijing makes a spreadsheet move, and suddenly your dream home costs an extra 50 grand in interest. Let me back up. For over a decade, China was America's biggest lender. They bought up US Treasury bonds like they were blue chip. Cards safe, liquid, and dollar-backed at the peak. They held over $1.3 trillion in US debt, but now? That number's collapsed to just over $750 billion. And in the last 24 months, they've quietly sold off another $300 billion. Not with headlines, not with sanctions. Just a slow, steady dump through intermediaries in Belgium, the Caymans, and the London clearinghouses. So here's the question nobody in DC wants to answer. What happens when your biggest creditor walks away? From the table? What happens to Treasury yields? To your car loan? To your mortgage rate? And is this just economic diversification or financial warfare? Because what China's doing looks a lot like what Russia did in 2014 and what Saudi Arabia threatened in 2018. And every time the US public paid the price. Let me walk you through it. We'll break down what China sold, why it matters, and how this might just be the most expensive silent protest in modern financial history. For years, China didn't just buy US debt, they built a mountain out of it. Here's why. Back in the early 2000s, China was running massive trade surpluses. They sold us everything from toys to TVs and got paid in US dollars. But instead of spending those dollars, they recycled them into US Treasury bonds. Why? Because Treasuries were the safest asset on earth. Stable, liquid, denominated in the same currency their exports were paid in. It was a way to park hundreds of billions without crashing the dollar, since buying US debt helps keep demand for dollars high. By 2013, China held over $1.3 trillion in US government bonds. That's trillion with a T. They were America's largest foreign creditor by a mile. But then came 2018. The US-China trade war exploded, tariffs, sanctions, tech bans, and suddenly China started seeing those treasuries less like an investment and more like a vulnerability. Because what if Washington froze their assets? What if sanctions hit the bond market? What if the dollar got weaponized? So they started quietly selling, not all at once, just enough to shift the balance. By 2022, their holdings were below $1 trillion. By 2024, around $800 billion. And now? Closer to $750 billion. Some call it diversification. Others call it decoupling. Either way, it's a warning shot. Because this isn't just about what China's not buying. It's about who fills the gap and what it means when your biggest lender decides they're done lending. So how exactly does China sell $300 billion in US debt? Without setting off alarms? Simple. You don't sell directly from Beijing. You unwind through quiet channels, custodial accounts in Belgium, shell firms in the Caymans, and private brokers in London. That's why you'll see headlines like, Belgium reduces Treasury holdings by $40 billion, and analysts go, yeah, that's probably China. It's the financial version of laundering intent. Same assets, different hands, less visibility. Now let's talk numbers. The US Treasury publishes monthly data on foreign holders of debt, and since 2022, China's official position has dropped by roughly $300 billion. That's not a panic sale, that's a cold, methodical exit. And here's why it matters. When a major buyer like China dumps treasuries, demand drops. But the US still needs to borrow, so to attract new buyers, what do? They raise yields, which means if the 10-year Treasury yield climbs by, say, 1%, your mortgage rate could jump by the same amount, and that's not abstract. On a $500,000 loan, that's over $100,000 in extra interest across the life of your mortgage. You seeing this? China's dumping debt to shield itself from US pressure and in the process, raising the cost of capital for every American homeowner. That's not just geopolitics, that's your monthly payment going up. And the best part? There's no announcement, no press conference, just a spreadsheet and a missing line item from the creditor list. Here's where it hits home literally. US mortgage rates don't just float in a vacuum. They're tied, almost handcuffed, to the yield on 10-year Treasury notes. When those yields spike, so do the rates on everything from fixed-rate mortgages to student loans and business credit. So when a massive player like China starts pulling money out of treasuries, that's a seismic shift. Let's say the US government is auctioning bonds to raise cash. If China's not showing up at those auctions anymore, someone else has to fill the gap. But most investors won't buy US debt unless they're offered a better deal, meaning higher yields. Higher yields equals higher borrowing costs. That's why in late 2025, after a string of quiet Chinese sell-offs, the 10-year yield suddenly jumped to levels we hadn't seen since 2007, and that spike, it sent the average 30-year mortgage rate soaring past 7.5%, a number that used to be unthinkable for a whole generation of homebuyers. Now let's put that in real terms. If you were house hunting with a $2,000 monthly budget, that same payment gets you $80,000 less home when mortgage rates jump by a single percentage point. Think about that. China shifts a few billion in a spreadsheet, and you lose a bedroom, or a school district, or a backyard. This isn't theoretical. This is how a macro play becomes a middle-class squeeze. And if you think rates are high now, just wait until more foreign lenders get nervous, because once the sell-off starts, it's not just about China anymore. This isn't the first time America's lenders have used treasuries as leverage. Flashback to 2001, for Russia gets hit with US sanctions after annexing Crimea. What do? They dump a massive portion of their US debt holdings almost overnight. Not because they needed the cash, because they didn't want the US to freeze it. That same year, Saudi Arabia quietly threatened to do the same thing. The message: weaponize the dollar and we'll weaponize your debt. Now jump back to China in 2025. The pattern's familiar, except it's quieter, bigger, and more dangerous. Because China isn't just making a point, they're reshaping the rules. And it's part of a broader move you've probably heard whispers of: de-dollarization. Yeah, it's the buzzword on every finance podcast right now. But here's the meat behind the headline. When China sells US treasuries, they're not putting that money under a mattress. They're rotating into other reserves: gold, euros, yen, even digital yuan. They're building swift alternatives, settling oil trades in yuan, and backing trade pacts that skip the dollar entirely. In short, they're retrying to build a new system where Washington can't push a button and freeze assets at will. So what looks like a financial move, dumping bonds, is actually a strategic decoupling from the US dollar itself. And the more countries who follow that script, the more fragile the old system becomes. Because for decades, the petrodollar and Treasury debt were the two pillars holding up America's low-interest fantasy. And now both are cracking. If China's walking away from US debt, who's stepping in? Short answer: not enough people. Japan is still America's top foreign creditor, but they're not buying aggressively. In fact, even Japanese holdings have started to level off as the yen collapses and Tokyo scrambles to defend its own economy. That leaves the US turning inward. Domestic banks, pension funds, insurance companies, these are the new buyers of last resort. And they're only buying when the yield makes sense. In other words, interest rates have to stay high to keep them interested. There's also hedge funds and speculators. Wall Street loves a deal, and when bond yields spike, some funds rush in to grab short-term profits. But here's the problem: speculators are not long-term holders. They're renters, not owners. So the more Washington relies on them to absorb Treasury debt, the more unstable the whole setup becomes. And don't forget, the US is issuing more debt than ever. With total national debt now over $38 trillion, we need consistent buyers to fund the government month after month, year after year. So when China says, we're out, and Japan says, we're not buying more, and Wall Street says, only if the price is right, you start to see the squeeze. This isn't just about who's holding America's IOUs, it's about whether there's anyone left who wants to. And if the answer is no, well, that's when the real interest rate pain begins. So what happened after the sell-off became too obvious to ignore? Markets flinched. In early 2026, Treasury auctions started missing expectations. Yields jumped, bond volatility spiked. And CNBC panels started asking the question no one had touched in years: what if US debt isn't actually risk-free anymore? The Federal Reserve tried to calm things down. They signaled rate pauses, hinted at balance sheet flexibility. But the message was already out. America's biggest creditor just pulled back. Meanwhile, mortgage lenders got skittish. Banks tightened up approvals. Refinancing dropped off a cliff, and new home buyers? They started waiting, not because prices were too high, but because borrowing was too expensive. Small businesses got caught in the crossfire too. Commercial credit lines shrank, loan rates ballooned, and suddenly, soft landing felt more like financial whiplash. In Washington, the spin machine kicked into gear. Officials called the bond market healthy, blamed temporary technical factors, claimed strong domestic demand would replace foreign buyers. But the bond market didn't buy it, because charts don't lie. And when your second largest lender shrinks their position by $300 billion, that's not noise, that's strategy. Because China wasn't panicking. they were planning, and America just got reminded that being the world's reserve currency doesn't make you invincible, especially when your friends stop showing up to by the bill. Fast forward to right now. China holds just over $750 billion in U.S. Treasuries, its lowest level in over 15 years. Meanwhile, U.S. mortgage rates are hovering near 7.5% to 8%, the highest in a generation. Coincidence? Maybe not. Home buyers are sitting out, refinancing is dead, and the housing market is cooling fast, not because people don't want homes, but because they can't afford the loans to get them. And here's the irony. The Federal Reserve is under pressure to cut rates, but bond markets won't let them not while demand is shaky and foreign holders are bailing, so the Fed's stuck. If they lower rates too fast, they risk spooking investors who are already reluctant to hold U.S. debt. If they keep rates high, they choke credit and crush consumer spending. All of this traces back quietly but directly to China's exit strategy. At the same time, Beijing is loading up on gold, testing central bank digital currencies, cutting dollar usage in trade deals with Russia, Brazil, and even parts of the Gulf. It's a playbook shift, and if more countries follow, if Saudi Arabia or India or Brazil start trimming their U.S. bond holdings, mortgage rates don't just stay high. They become the new normal, and your cost of living? That gets baked into the cake, because what started as a slow unwind of $300 billion might be the first domino in a global retreat from U.S. debt. This isn't just a story about China. It's about a fragile system built on two assumptions. One, that the U.S. can always borrow as much as it wants. Two, that the world will always show up to buy. For decades, that worked. America ran up trillions in debt. And countries like China, Japan, and Saudi Arabia parked their excess cash in treasuries, safe, predictable, dominated by the dollar. But now, that contract is fraying, because every time Washington uses the dollar as a weapon through sanctions, freezes, or tariffs, other nations start asking, why are we financing the very system that could be used against us? 3 reasons this dynamic is cracking. 1. U.S. debt is exploding over $38 trillion and climbing. Buyers are starting to ask what the endgame looks like. 2. Political risk is rising. What if future administrations escalate sanctions? Freeze more reserves? Play chicken with the debt ceiling? 3. The world has options now: gold, yuan-based trade, regional banking blocks, even crypto. China's $300 billion exit isn't the collapse of the dollar, but it is a red flare. A signal that the balance of power in global finance is shifting quietly, deliberately, and without firing a single shot. Because in the end, the dollar's dominance doesn't depend on tanks or treaties. It depends on trust, and right now, that trust is leaking one treasury bill at a time. So here's the trillion-dollar question. Should a foreign government be able to raise your mortgage rate without firing a shot? Because that's exactly what's happening. China didn't issue a threat, didn't make a speech, didn't even tweet. They just sold. And suddenly, your cost of borrowing goes through the roof. So drop a comment. Was this a smart financial move by China or a silent shot in an economic war? Think this is just about politics and bond yields? Tell that to the millions of Americans now priced out of the housing market. If this breakdown helped you connect the dots between geopolitics and your wallet, share it, not for hype, for clarity. Because the next move might come from somewhere even closer. In the next episode, we look at Japan, now the largest foreign holder of U.S. debt. What happens if Tokyo starts doing what Beijing just did? What happens when both legs of the U.S. debt stool start wobbling? And how do you protect yourself when the real fight is over interest rates? As always, every claim in this video is backed by public data, U.S. Treasury reports, bond market records, and financial news sources like Reuters, Wall Street, and the Daily Brief. This isn't fear. It's facts. And if it sounds dramatic, that's because the system we live in is follow the money.